Imagine walking into a store, picking up your usual groceries and suddenly realizing everything costs 10% more. You haven't changed your shopping list, so what happened? The answer: taxes you didn't even realize existed. Every single day, governments make decisions that silently dictate how much you spend, what you buy, and even when you make purchases. From VAT to hidden levies, taxation shapes consumer behavior in ways most people never stop to think about. But who really benefits? And is there a better way to design tax policies that help both consumers and the economy? In this video, we will explore how taxation shapes consumer behavior and spending using real-world case studies. We will also break down key policy recommendations and explore how government can craft tax policies that balance economic growth, consumer welfare, and revenue generation. Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of taxmobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. Let's start with the theoretical framework: how taxation influences consumer behavior. Economic theories suggest that every time government increases taxes, it actually changes the way you shop, save, and spend. Whether you realize it or not, taxes shape your choices every day through various mechanisms such as 1. The income effect. Think about this. When you get paid, the first thing that happens is a chunk of your salary disappears as taxes. That means less money in your pocket, which directly affects how much you can spend. On the other side, when governments introduce tax cuts or lower income tax rates, people have more to spend, which boosts the economy. 2. The substitution effect. Ever notice how people change their buying habit when prices go up? Taxes play a huge role in this. Let's say the government increases taxes on sugary drinks. Many consumers might start choosing water, unsweetened beverages, or homemade alternatives instead. If luxury items get hit with a higher VAT, shoppers may start opting for more affordable alternatives. On the other hand, if essential goods are tax-free or taxed at a lower rate, people naturally spend more on them. 3. The psychological impact of taxes. Our perception of taxes affects how we spend money. Research in behavioral economics suggests that when taxes are visible, like VAT added at checkout, people tend to reduce their spending than if the taxes are embedded in the price. When people hear about upcoming tax hikes, there is often a rush to buy things before prices go up, leading to short-term spikes in consumption. Uncertainty about tax policies discourages long-term investment and major financial commitments. In essence, taxes shape how we spend, what we buy, and even when we buy it. Now, let's consider the key areas where taxation affects consumer spending. 1. Disposable income and purchasing power. The most direct impact of taxation on consumer behavior is through changes in disposable income. Different taxes impact this in different ways. Personal income tax. A progressive income tax system where higher earners pay more reduces disposable income and affects consumption patterns. Corporate tax. Higher corporate tax rates can lead to lower employee wages or increased prices, indirectly reducing consumer spending. Consumption taxes like VAT or sales tax. These affect all consumers but disproportionately impact lower income households that spend a higher percentage of their earnings on consumption. 2. Price sensitivity and demand elasticity. As taxes reduce income, they also change the final price of goods and services, making some products less attractive to consumers. How much this affects demand depends on whether the product is a necessity or a luxury. Necessity, such as food, healthcare, and education, these have inelastic demand, meaning even if prices go up due to taxes, people will still buy them because they are essential. Luxury goods, e.g., jewelries, designer clothing, etc., these have highly elastic demand, meaning even a small tax increase can lead to a sharp drop in sales as consumers switch to cheaper alternatives or delay purchases. Sin goods such as alcohol, tobacco, and sugary drinks. Governments impose higher excise duties to discourage consumption while generating revenue. 3. Taxation-induced changes in consumption patterns. Beyond simply raising or lowering prices, taxes can actively shape consumer behavior. Governments use them to encourage or discourage certain choices. For example, excise taxes on unhealthy products reduce consumption. Green taxes on fuel and carbon emission encourage consumers to adopt environmentally friendly alternatives like electric cars. Reduced VAT rates on education and healthcare promote access to essential services. 4. Behavioral adjustments and tax avoidance. When taxation becomes excessive, consumers alter their behavior to minimize tax liabilities. Cross-border shopping. High taxes on certain goods lead consumers to buy from neighboring jurisdictions with lower taxes. Underground economy. Excessive tax burdens encourage informal market transactions where tax compliance is low. Stockpiling and bulk purchases. Consumers buy in large quantities before anticipated tax hikes. Now, let's consider some real-world case studies on taxation and consumer spending. Case study 1, Nigeria. VAT increase from 5% to 7.5%. In 2020, Nigeria raised its VAT from 5% to 7.5% to boost government revenue amid economic challenges. This led to an increase in the prices of goods and services, hitting low-income earners the hardest. To cope, many consumers shifted their purchases to informal markets where VAT compliance was weaker, reducing the government's expected revenue gains. At the same time, businesses, especially in retail and entertainment, saw a drop in discretionary spending as people tightened their budgets. Case study 2, United States, temporary payroll tax cuts. During the COVID-19 pandemic, the United States government introduced a payroll tax deferral program to give people more disposable income and stimulate spending. In the short term, this helped prevent a deeper recession. But instead of rushing to spend, many consumers and businesses chose to save the extra cash, limiting the policy's overall impact on economic recovery. Case study 3, United Kingdom, sugar tax on soft drinks. The United Kingdom introduced a tax on sugary drinks, which led to a 28% reduction in sugar content. As a result, consumers switched to healthier alternatives, achieving the government's public health objectives. Policy recommendation for optimal taxation. To achieve a balance between revenue generation and consumer welfare, governments should consider the following tax policy strategies. 1. Tax relief for low-income households. Reducing VAT on essential goods, e.g., staple foods, medicine, to protect purchasing power. Implementing tax credits or negative income tax systems to enhance disposable income. 2. Progressive taxation on luxury goods. Higher tax rates on luxury cars, jewelries, and high-end services to increase revenue without affecting basic consumption. Adjusting excise duties on harmful products, e.g., alcohol, tobacco, to balance revenue and behavioral change. 3. Targeted tax incentives for economic stimulus. Temporary VAT reductions or tax holidays to stimulate spending during economic downturns. Investment tax credits to encourage spending in specific sectors like technology and renewable energy. 4. Transparent and stable tax policies. Avoid frequent tax changes that create uncertainty. Implement gradual tax reforms to allow consumers and businesses to adjust. In conclusion, taxation is more than just a revenue generating mechanism. It is a critical instrument that shapes consumer behavior and economic activity. While excessive taxation can discourage spending and encourage tax avoidance, well-structured tax policies can guide consumers towards responsible consumption, economic stability, and sustainable growth. For governments, the challenge lies in striking a balance between taxation and consumer welfare, ensuring that tax policies are equitable, predictable, and growth-friendly. A carefully designed tax system with progressive rates and targeted incentives can maximize both revenue collection and economic prosperity. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.